Hello and welcome to today's webcast, How to Rise to the Fair Valuations Challenge in Times of Extreme Market Volatility. My name is Victor Anderson. I'm Global Content Director of WatersTechnology, and today's event is sponsored by Refinitiv. Before we start, I'd like to thank you all for your attendance today. I know that we have a large number of people on this call, and I should imagine that most of you are sitting either at home in your office or on your sofa. And I hope that you, your families and colleagues are well wherever you might be at this time. It goes, therefore, without saying that this is an unusual time for us, but thanks to technology, we're able to come together to participate in what I'm sure will be a really good session. Today's panelists include Carlo Acerbi, who is Head of Valuation and Quantitative Solutions at Bank Pictet in Geneva, Simon Storey. Sorry, I had a technical glitch there. Introducing our second panelist of the day, Simon Storey, Head of Operations, Security Valuation for UKMEA at State Street. Abdellah Adhana, who is Manager of Fixed Income and Derivatives Valuations at Refinitiv. And as I said, my name is Victor Anderson, and I'm going to be moderating today's discussion. Now, as an intro to today's audience members, the event is scheduled to run for approximately 60 minutes and will consist of a panel discussion and 4 poll questions, which I will push out to audience members during the course of this hour. I'd be grateful if you take the time to respond to each of those questions. Simply click on the most appropriate option and you're done. Each poll question will be open for approximately 5 minutes. And finally, if you do have a question of your own for members of today's panel, you can direct it via the little purple button, the Q&A tab, which you will find at the bottom of your screen. Now, today's webcast comes on the back of a piece of research carried out by Risk.net and WatersTechnology on behalf of Refinitiv, the findings of which were published in a white paper fairly recently. That paper is titled Fair Valuations, What Lies Beneath. You can download a copy of that paper for free. It's on the top right-hand corner of your screen as you're looking at your screen right now. Today's discussion points will be as follows. We're going to be looking at capital markets firms' current pain points with respect to developing fair valuations for securities they hold. We're going to be looking at the specific use cases within capital market firms that have been impacted by fair valuation requirements and obligations. We're going to be looking at the regulatory, business, and operational implications that firms need to consider when valuing hard-to-value securities. And finally, we'll be looking at the qualities that firms are looking for in a valuations partner. Please note that the views expressed in this webcast are those of the guest speakers and do not reflect the official policy or position of the firms that they represent. Examples described within this webinar are only for learning purposes, and the assumptions made within suggested analyses are not reflective of the positions of any corporate entities. So, as a point of departure for today's discussion, I'd like to ask firstly Carlo, then Simon and Abdellah very briefly to talk to introduce themselves and explain their day-to-day roles with respect to the subject of today's discussion. So firstly, Carlo, then Simon and Abdellah. Over to you.
Thank you very much. Thank you very much for the invitation. My name is Carlo Acerbi. I work for Bank Pictet of the offices of Geneva in Switzerland. And I've recently joined the Group Risk Management Department in the Investment Risk Division. With relevance for this roundtable, my role at Pictet covers in particular model risk and liquidity risk for the entire group, which includes a private wealth division, an asset management firm, and a custodian bank. So fair valuation and valuation in general is seen from where I work from multiple angles, and so we are subject to the problem that is the subject of this roundtable today.
Good, thanks, Carlo, very much. Simon.
Yep. Okay. Good afternoon, all. Simon Storey from State Street. I head up the UKMEA Valuations team, predominantly focused on middle office and back office valuations. However, obviously, all facets of valuation within UKMEA book within State Street. Very much focused on client service locally, as well as product and governance and oversight of any outsourced valuations internally.
Good. Thanks for that, Simon. Abdellah.
Thank you, Victor. Hi, everyone. I hope everyone is well and safe. My name is Abdellah Adhana. I'm based in London, and I manage the evaluated pricing operations for Refinitiv. Our objective is to produce fair value pricing, independent fair value pricing across various sectors in the fixed income markets and derivatives.
Good. Okay, gentlemen, thanks very much for that. Let's move on to the first discussion point for the day, which I'll introduce to audience members briefly in a moment. But what I'd like to do first is to open the first poll question so that audience members can get stuck in right from the start. The first poll question should be on your screen now. It reads, are the challenges around developing fair valuations for hard-to-value securities getting easier to address? We'd really like to hear what you have to say about this. And we know that there are a large number of people on this call, so we should be able to get a fairly good sense of what's going on in the marketplace right now from a kind of a practitioner's perspective. So you answer those questions. You simply just click on the most appropriate option. And we will then carry on with the discussion. And the first point that I'd like to put to our panelists today is, what do you see as the primary challenges facing capital markets firms in developing fair valuations for the illiquid and therefore hard to value securities that they hold? I'd like to ask Carlo to maybe kick this question off. So you talk about valuations, Carlo, as a kind of a multifaceted, and you look at valuations from various different kind of perspectives within the bank. And so what I'd like to do is try to get a sense of what your day-to-day challenges are around developing fair valuations for the hard-to-value securities. Obviously, for a lot of the equities, it's not a problem, but for the more esoteric instruments, it is a bit of a problem. And I'd like to hear what you have to say, and then Simon can carry on that discussion, and then we can also hear from Abdellah, and he can give us a sense of what he's hearing from typically the firms that he talks to. So, Carlo, why don't you kick off the discussion on the challenges?
Yeah, thank you very much. I think that well, I will be saying something quite obvious, but ultimately the roots of the problem stems from the existence of a unique and transparent market. Okay, so whenever a market has a central place to trade at, and it's visible to all pre and post trades, we are all okay. Okay, so if trades are very frequent, if there is a single market, be it a physical place or an electronic place, and if all actors in that market show up in the same place and tell each other what they do and what their intentions are, so quotes and trades, well, we are all in a perfect situation. Okay, so to get a fair price, we just have to reach out to the market and ask for a mark to market. Okay, but I said three things. Okay, one single place, which is not always the case. Okay, so whenever we have fragmented markets or OTC markets, heavily OTC markets, the market is actually scattered around in clusters, when not in bilateral conversations that occur disjointly from the rest of the markets, or plural. Okay, so, and that's the first point. The second being transparency. So even when something happens in let's say a single place, it may not be communicated timely and transparently to the rest of the financial community. So we cannot access the information, even when maybe the information is stored somewhere. Okay, and maybe we will touch on this point later when we will speak of the disappointment about MiFID II illusion of large transparency reforms for the market. Well, long story short, that those two, market fragmentation and absence of market transparency, are the main problems. And of course, trading frequency is yet another one. When assets are traded very infrequently, in the meantime, you have probably to make many assumptions to make a decent model price when mark-to-model when a mark-to-market is not available. So these three problems are there, have always been there. I don't think that there is any ultimate solution, and ultimately this is what everybody is fighting against when we want to make a fair valuation. So probably this sets the stage for more detailed answers from my colleagues in the round table.
Yeah, possibly. I certainly hope so. And so what I'm going to do is just ask Simon to give State Street's perspective, or his own personal perspective as well, as someone who's been in the marketplace for a while. Do you have anything to add, or is that consistent with your view of the world?
Yeah, I think it does link to my view. Price discovery, in essence, right, is the key element. You know, where you haven't got the transparency, finding a price that is readily available, and as well as can be relied upon, and this includes vendor model prices for those illiquid assets, along with, you know, sort of getting the colour behind those values that can support the challenge. I would say, you know, ensuring such prices can be received in a set format, in a regular basis, on a regular basis, and easy to digest. You know, so we're reducing sort of the operational risk around the receipt of those prices. And as well as if we see difference in values across vendor or brokers, if there's ambiguity there, how do we establish which is the most accurate fair value? And then lastly, I would say it's the cost in both the data and ongoing monitoring, because, you know, you've got mitigating factors around these key challenges that most firms will put in place, and, you know, having agreements in place with vendors that have good coverage, you know, having technology there, strong policies in place, and full transparency to allow clients, you know, the opportunity to have a view on that and to challenge any illiquid valuations, and so you can evidence and back up accordingly. And then working with vendors to try and reduce those costs, right? And to have as efficient, automated processes as possible.
Yeah, thanks, Simon. That's kind of ended our discussion for the day. It appears that you've literally covered everything in a single answer, and you know, this is not a trivial issue. I totally get that, and there are massive challenges. Just from a kind of you know, you just given a really good overview of the multifaceted kind of the challenge facing capital markets firms. Abdellah, I'm going to put you on the spot a little bit as well, and just say, you know, what are you hearing from your clients right now? Where are their specific challenges? Carlo mentioned if there's a you know, if there's a single venue and there's a lot of transparency, then it's and these securities are traded regularly, then that's not a problem. You know, that's a fairly simple challenge to address. But let's talk about the real challenges now. What are you hearing from buy-side and sell-side firms that typically come to you and say, listen, you need to help us with whatever it is that we're trying to do? What are you hearing from them?
Sure, thanks, Victor. And I completely agree with what Carlo and Simon just highlighted. I think the primary issue, in particular on the current market conditions, is really the access to information, the transparency behind it, but also the quality, which I believe is the main challenge that our customers are facing. Customers do see wider dispersions in the marketplace, scattered all over the place between various asset classes. And so, of course, we are in a unique situation at the moment. It's a market that is at distress, a market that is dislocated. And so it brings high complexity in producing fair value for those assets. We tend to separate the various credits in a number of categories. You have the more liquid instruments where you would apply a mark-to-market pricing approach, which is fairly straightforward. Again, mark-to-market does mean that you do depend on relationships and access to market sources, and these need to be validated as well. And we do see quite high variances, various opinions and assumptions in the marketplace, which are not necessarily consistent with each other. So I think that's another challenge that our customers are facing with regards to the mark-to-market pricing approach, is to there are various assumptions in the marketplace, various opinions, and how do we kind of come up with the most appropriate assumption that would justify fair value. So that's more on the more liquid instruments. Again, in this current market condition, it's still fairly complicated to really price those instruments. On the less liquid, hard to value instruments, I think that's where the access to information and the transparency behind it and the quality of it, which is the main concern and challenge for our customers. And that's where, and also between vendors, you would see, wider dispersions. So I think the key here is to really look for a consistent methodology that is applicable across the board on a global scale. So you are allowed to apply a portfolio analysis. So that's where and to kind of focus on. But I think I would say these are the main challenges that our customers face at this stage.
Good. Okay. That's a great start to today's discussion, and thanks very much all for framing the challenge facing market participants. The first poll question has been open for a while, and we're going to push the results out to audience members. You should be able to see the results in front of you now. Almost 2/3 of respondents, about 60%, said believe that the issues, the challenges around developing fair valuations for hard-to-value securities are as fraught as ever due to the complexity of the securities we invest in. No great surprise there, and I can't imagine that's going to change anytime soon, given the fact that equities and very vanilla fixed income instruments are just not providing the kind of the returns that a lot of investors are looking for. And so that we're looking at more esoteric instruments going forward, which in itself kind of perpetuates this challenge around fair valuations. So to audience members today, thank you very much for your responses. Really appreciate it. What I'm going to do now as quickly is open the second poll question and push that out to you. And what we're going to be discussing then is, okay, so we framed the challenge. What I'd like to know from, I'm going to push this to Simon first and then to Abdellah and then Carlo. What is driving these challenges? So we can observe the challenges, we understand the challenges to a certain extent, but what I want to know is where is all this drive coming from? Are they internal drivers? In other words, from the business itself, in terms of calculating timely and accurate NAVs, for example, if you're an asset manager? Or are they being driven by regulatory mandates? Or indeed, are they being driven by an investor's expectations for greater transparency and granularity into how valuations are being derived and applied? What would you say to that, Simon? Where are these drivers coming from?
Yeah, in a broad sense, I would say all facets that you mentioned, are contributing to that. I feel that where regulation clients are pushing that way, and in essence, the need for quicker information, we're being pushed to that, right? I mean, doing valuations for an administrator, accuracy is primary, right? And everything being done should be pulling towards ensuring fair value can be gained, along with any transparency, market colour that can be evidenced to support communication, decision making, any trade info, etc. And then timely valuations, you're doing that per your price source agreement, per your service level agreements. And one also has to consider resiliency there as well, right? See a potential impact in the industry. So, resiliency after the financial crisis is obviously a huge factor. So there's many reasons why the need for speed is there. And then often speed of implementation can be a challenge, right? For new illiquid product to be traded shortly by a client. Vendor coverage has to be gained at times. Possible amendments of any agreements and policies, increasing governance and workload. And then I would say then any sort of new model would potentially need to be signed off as well. So there's a number of reasons why that speed's there, and I think again, as you mentioned, I don't think it's going away anytime soon.
Yep. Okay. Abdellah, where do you think the drivers are coming from then for greater granularity and more accuracy in terms of deriving fair valuations, especially for the more difficult, more esoteric instruments? Where is that coming from?
So I think looking at the various use cases, so one of the use cases, and Simon is obviously well versed there, is from admin space, looking at the vendors. It's predominantly for calculating net asset value calculations. There are various. If you look at it back in the years, clients would say, "Give me a price and it's sufficient." But right now, there is more demand for a justification for rationale behind the valuations. And that's also driven by the mandates from the end clients to be more transparent and expectations of transparency, but also driven by regulations as well. So we do see more and more demands from that aspect as well. But if we also look at from an end client perspective, we do observe, in particular, pre-COVID-19, where you would see more and more investors moving into high-yielding areas, emerging market credit,
yes,
where they look for more for new information flow, and that's where it kind of triggers the urgency to look for more transparency from pricing sources. So there are various expectations, and also from looking at from a reporting point of view, i.e.
yes,
the IFRS standard, which is a commonly applied reporting mechanism. That drives urgency as well for more transparency and for more price discovery.
That's IFRS 13, correct?
That's right. Yes.
Yeah. Okay. Good. All right, Carlo, I'm going to put the same question to you, but from Bank Pictet's perspective. Is your need to value these hard to value instruments accurately, timely, etc. Is that being driven by the business itself, or has it been driven by kind of client expectations and the fact that end investors, that clients are becoming a lot more savvy and a lot more demanding in terms of what they expect from their service providers? Where is it coming from?
Yeah, thanks. I think. As actually Simon said already, it's all of them, and I would tend to separate where it's driven by business, by regulators, or by client demand. Okay, so in a firm like ours, we certainly see, for instance, primarily need for fair valuation driven by business when it comes to trading operations. So trading and execution, a trading floor and risk management around the trading floor requires very, very attentive valuation for not only valuation purposes, but also for risk management and hedging purposes. Okay, any misprice
yes.
could cost you a bad decision. Okay, so whatever it is, and then it's much regulatory driven when it comes to pricing the banking book, for instance, where not only fair valuation comes into place, but prudent valuation. Okay, so and I'm referring to EBA prudent valuation regulation, and for instance, okay, so there is an area where there is a model on top of all the models you need to price assets. So prudent valuation regulation per se is a model, and there are large efforts in all companies subject to this regulation to do their best effort to put on top of a fair valuation also additional valuation adjustments, as everybody knows. And then when is the client that drives this need? That is really when I think of my wealth management division or asset management division. So when we want to have our clients confident with the revaluation of their portfolios or their private portfolios or their funds, the funds they invest in, it's not only a matter of having a point-in-time good valuation, but actually an auditable story of valuations that makes sense. So it's not only having the right price today, but explaining why it changed from yesterday's to today value with a defensible story. Okay, so models have to be robust, and data has to be auditable all along the history of the pricing of any single contract. And so, as you see, there is a convergence of drivers and slightly different drivers for different businesses in the bank.
Yeah. So you mentioned auditability and defensibility and being able to show, to provide granularity and transparency to end investors that, how you got to be able to kind of explain how you got to a point where you valued an instrument at a particular level, right? To what extent are they kind of, are they putting pressure on, let's not necessarily talk about Bank Pictet, but in terms of your experience in the marketplace, are end investors, are their expectations kind of heightening all the time and putting pressure on service providers for greater granularity and transparency and kind of explainability around the values that they assign to certain securities?
I think so. Over the years, I've seen increasing culture in bank clients. People have got to the point where they are risk managers of themselves. They, of course, delegate to their portfolio managers the real job. Okay, but they are competent. Okay, they understand, and then in particular, they understand when something is going wrong. Okay, when something doesn't make any sense. So. A bank should always prevent this from happening. Credit means they trust you, okay? And a bank should be trusted in the job of providing correct information and auditable information. Clients will dig into that information to the point that they can, okay? And it's a matter of confidence, okay? You have to deserve the confidence that your investors put in the bank that revaluates their portfolios. So it is a very high responsibility when it comes to fair valuation. That's my opinion.
Okay, good. All right, gents, let's leave that there. We've spoken about the challenges and the drivers of those challenges now in the marketplace. We're going to change tack now, and we're going to be talking about, so what are the how do you address those issues? And we're going to get onto that in a moment. But what I'd like to do is close a second poll question. It's been open for a number of minutes now, and we should have our answers. You should be able to see your answers in front of you now, and to all today's audience members. Almost 50% of respondents said it's primarily externally driven, and end client demands expectations for more accuracy, transparency, and granularity. That's really interesting. And only 23% of respondents said it's been driven by internal factors. To the question, what is driving your firm's need for more accurate and timely valuations? That is really interesting. So almost half of respondents believe that it's been driven by end investors, which, as we know, if they vote with their feet and withdraw assets and place them elsewhere, then there's only one loser, and that's the asset manager. So they're going to need to yield going forward into those demands for greater granularity. Anyway, right. As I mentioned, we are going to change tack now, and we're going to be talking about the way forward. I'm going to put the first question to Abdellah around what pricing and or valuations providers can do to help alleviate the burden on capital markets firms when it comes to developing fair valuations for the liquid securities they hold. Obviously, you're going to speak about Refinitiv's perspective, but obviously Refinitiv is one of a number of different providers, and obviously Simon, you'll speak from State Street's perspective, and Carlo from Bank Pictet's perspective. What we're trying to get here is a kind of a sense of what providers can do in this space to help capital markets firms get to the point where they can feel confident that they are providing fair valuations, especially for the difficult to value instruments that they hold. Abdellah, what is your response to that?
Yeah, so I think the importance number one is to keep the independent pricing. I think that's the key from a Refinitiv standpoint. That the market data, the market color, the market information, anything that feeds into an evaluator is obtained in an independent fashion. I think that the other key aspect of that is also the ability to cover on a global scale to allow for consistency across the board. As you can imagine.
So is that the broadness of your network, for example? The Refinitiv network and the right. Okay.
That's right.
Yeah.
So
all right.
Having various professionals performing valuations in different locations and different portfolios, and making sure that there's a clear connectivity between those professionals to allow for consistency. In particular during this market condition, where and in March, at the end of March, where we see high volatility, it's really important to have a communication line on a global scale to allow for, if there's a particular impact on a specific sector or industry, for example, the energy markets, that the wider teams across the globe are aware and familiar of this new information. And this new information is also feeding in by minutes, right? It's changing and it's having impact on our portfolios and our pricing accuracy. So I think that's key to have that global setup and to ensure this internal flow of information that is fully up to date throughout the day. I think also, which is key to the process, is to allow for to ensure that the methodology that is being applied is transparent, it's open, and it's also replicable to our clients. So our clients are in the positions to replicate the fair value pricing, and then finally. Following to that is there is the case of challenges or difference in opinions. There's always an opportunity to access to experts, right? To ensure there is a platform to connect with the particular evaluator or person or professional to exchange information, exchange opinions, so you understand the assumptions that have been applied into a particular price. So I think these are mainly the key drivers of making sure that the price of particular assets is done in an appropriate way. And just to add on that as well, is from an operational controls, I think it's also key to ensure that there are policies that are followed consistently, i.e., making sure that the operational controls and the risk of that is mitigated, and that's also managed centralized as well. So I would like to end it here, but I think these are the key points.
Yep. Just before we move on, Abdellah, you mentioned that at the end of March there was extreme market volatility, especially in the energy markets. Did Refinitiv experience a surge in calls from clients looking for greater color and support around the securities that they were investing in at that time? Are you aware of any kind of surge or do you want to talk a little bit about the scenario around that?
Of course, yes. So the way the service set up is that we have our clients connecting with our evaluators, and there's continuous conversation on a daily basis. But we did see a significant larger number of engagements with our customer base with regards to the volatility, and in the energy market is one of the sectors that's been impacted heavily, and we are expected to really produce and provide the underlying assumptions, the rationale behind our valuations, and also talk about the fundamentals that are driving financial markets, and that brings confidence to the customers. I think that customers do not only look for a particular price, they also need to understand why it's been marked at that level and what are the inputs behind it. And some markets are really not as liquid as the others. So there is a comparable analysis that is required. And there are various ways of methodologies to apply, but I think it's important to have a conversation with our customers. And we did see a surge in engagements, inquiries, in particular credits, portfolios. Energy market is one of them. Hospitality is the other sectors where we saw a lot of queries coming in. We also see some queries coming in for financials as well. And it's all driven by the weaker fundamentals that we are in at the moment, and that has impact on fixed income markets.
Yep. Okay. Good. Let's leave that there. Before I put that same question to you, Simon, what I'm going to do is push the third poll question out to today's audience members. The question is in front of you now. What is the most important factor to your firm when selecting a valuations provider? This is going to be really interesting. You've got about 5 minutes, and we'd really appreciate your responses to that question. Let's carry on now with that discussion, and I'm going to put the same question to Simon. Simon, how can pricing and or valuations providers help to alleviate the burden on capital markets firms? Have you got anything to add to what Abdellah was talking about? You know, what are the things that would help a company like State Street in terms, you know, from a kind of a pricing valuations perspective? What are the things that would pricing and valuations providers can do to alleviate that burden on an organisation like State Street?
Yeah, I mean, first and foremost, you know, it's being agile to support us in any facet of evaluation, right? New products and doing so in a timely manner. You know, sort of being the model of support for automation. Be consistent in support with minimal impact to delays. You know, so and should there be any issues, speedy escalation of IT issues. With quick remediation and colour, because you know there's huge focus increase from the regulator on vendor monitoring, quick turnaround times of any price challenges or info requests, ideally SMEs on demand should we need it. You know, giving that market or model colour where possible. Ideally, automatically in a feed or via a pricing portal or terminal. Supporting client discussions of new business or potentially switching vendor, and you know, one that's obviously going to be a key factor is that costs are managed well, and you know, when we talk about liquid assets, they generally are more costly to value. So
yes.
You know, as long as they are reasonable. And fair, then that's obviously something that vendors can support us on, and then finally, you know, being proactive in market events, you know, to alleviate any possible surprises, you know, for parties concerned.
Yep, good. Okay, final word on this issue from Carlo. What can the pricing valuation providers do to help alleviate that burden on Pictet, for example? If obviously you have a number of providers, or you have a primary provider. I don't really want to talk about that. I want to talk about what additional stuff other than what you're already getting now could help Bank Pictet in this. With this particular challenge, is there anything that you would like to see more of from a provider?
Well, I think we work with the excellent providers, and the service in this space is excellent. There are
yes.
a number of players that do an excellent job, and besides the obvious, so coverage, operational issues. Escalation and remediation of which I'm not really an expert of, because I'm not in the operations of the automation process of feeding our systems. What I can add
yes.
to this is a lot of competence. So data is mute if you don't understand. Okay, and data providers, when they are also experts of financial instruments at the same time, and experts of pricing models at the same time. In other words, when they understand the data fully and they understand the way the data can be consumed, can automatically be
yes.
advisors. Okay, so they can tell you how to best exploit that data. Okay, so it's a huge difference if you just have the right data, or if you also have an insight on top of that data. Okay, and also and this is something that competition between data providers has improved a lot over the past years. I've seen data providers becoming more and more competent in all these aspects, okay, and also a point that I would like to underline is benchmarking. So they have a unique position to see what the other financial institutions are doing to tackle the exact same problem you have, okay? And so think of IFRS 13, okay? So IFRS 13 is basically a regulation that is written on a best effort basis, okay? So you could do the best. You should do the best you can, okay? And they tell you do mark to market if you can, and then go to mark to model if not mark to market, and that shoots something in the dark, which is called level 3, okay? If you don't even have a model,
right?
Okay? You don't want to discover when you resort to level 3 that there was a level 1 solution to the problem, okay? And so you sometimes, if you work in solitude, okay, you wonder whether your best effort is the best thing you could do. Okay? So benchmarking practices is very important in this space. You would never ask another bank what they are doing; they wouldn't respond, okay? But you can certainly ask the data provider what they saw around in the marketplace, and this is something that data providers do and do very well.
Yes. That actually that brings me to on to another point, and that actually came through quite strongly in the white paper that that we produced for Refinitiv, specifically on this subject, and that came through, and it was described as the community effect, whereby, you know, to what extent can the whole community of clients benefit from, for example, one client saying, look, I've got a real problem around this. To what extent can that be extended to the rest of the group, and for the group to benefit as a whole from certain challenges that clients are facing? So that kind of benchmarking effect and the community effect, I think, is quite strong, and it certainly came through in some of the conversations I had when researching the marketplace and the challenges, etc., for that white paper. One on the subject of the white paper, to today's audience members, if you have arrived a little bit late and you weren't here for the start of this call, on your screen, in the top right-hand corner, you'll be able to see a link to the Refinitiv white paper. That is free to download. If you just click on that link, it'll take you through to Risk Library, and you'll be able to fill out details, your personal details, etc., and you'll be able to download that white paper free of charge. That just brings me to the issue of poll questions. The third poll question is now closed. What I'd like to do is just have a look at the responses to that poll question. The poll question is, are the challenges around developing fair valuations for hard-to-value securities getting easier to address? No, that's not the right poll question. I've got a bit of a glitch here on my side. Here it is now. It's just been brought up in front of me. What is the most important factor to your firm in selecting a valuations provider? Almost 90% of respondents said the accuracy, transparency, and reliability of the provider's pricing valuations data. Really interesting. I suppose there's no point in having a relationship with a pricing provider if you have to question the accuracy, transparency, and reliability of the prices you're getting from them. It kind of defeats the object of the exercise. So that is totally understandable. What I'm going to do is push out the fourth poll question. We're on almost 45 minutes into today's call. So the fourth poll question is going out to audience members now. This is a question specifically for end users. How many third-party evaluated pricing relationships do you currently have? It's either 1 to 2, 3 to 4, or more than 4. That would be really interesting. Please, you have about 5 minutes in order to respond. We'd be very interested to see exactly what the market is telling us with respect to the numbers of providers. We're going to be moving on now. I'm going to talk a little bit about COVID-19, seeing it's such a topical issue right now. So to what extent has COVID-19 impacted pricing valuations practices across the industry? I'm going to push this to Carlo. Has the industry changed, or will we get back to business as usual once the COVID-19 scenario kind of diminishes in terms of its impact on the marketplace right now, and what we what we are experiencing on a kind of a day-to-day basis in terms of lockdown. So, Carlo, do you want to talk a little bit about the COVID-19 impact on pricing and valuations? Because obviously we're still working, but we're working slightly differently. Will we go back to business as usual once the COVID-19 kind of influence is diminished? What is your view on that?
Yeah, I think that actually, for what concerns fair valuation, the world changed much less than we were afraid. Okay, under this COVID crisis, what I'm referring to is that this is certainly a very serious economic crisis, but not yet, maybe never will be such a bad financial crisis as we saw in 2008. Okay, so it's certainly, I mean, what we saw was that the market was much more resilient than we would expect, probably. And I think I know the answer, actually. The market is much more collateralized than it used to be. Okay, so what really changed from 2008 to 2020 is that the systemic risk is much lower, thanks to a much more controlled counterparty risk between large financial institutions. So the result was that traders kept doing their job. I didn't see empty quoting screens in the fixed income market as I saw in 2008. Okay, so the market, of course, was dislocated. Of course, we saw swings that were 10 sigma in some markets. Okay, unprecedented events in prices swings. Okay, negative future prices on oil and things that we would have never dreamed of. Okay, but in terms of functionality, the market kept working. Okay, the market did not break. This is what I have seen, at least from my angle. Okay, so nothing really changed. Okay, so we are experiencing an enormous stress test that is being, so to say, absorbed by the market. We are still in the midst of a crisis. Okay, and maybe God forbid we haven't seen the worst yet. I don't know, but for the moment the market is working. Okay, so liquidity after all is still there. Okay, and we haven't seen complete evaporation of quotes in any market. This is at least what I can witness from my point of view. And so, in a sense, yes, of course, we saw widening of bid-offer spreads. We saw, of course, a more difficult price discovery in many markets. There were operational disruptions due to probably home working. Okay, some prices, some communications got interrupted, probably because some companies had to reorganize their daily workload, and something went wrong. Okay, but this is completely understandable given the days we are living and the changes in the way people had to operate. But I did not see a market evaporation as in 2008. So this is, in a sense, something that gives me some optimism in the resilience of the financial system in this moment.
Yeah. So I suppose in that respect, Dodd-Frank in the US and MiFID II, and also the regulations ensuring that market makers can't just sit on the sidelines any longer. They have to continue to make markets, right? Ensures that there is liquidity, there are prices, and that there isn't a dislocation to the point where the market breaks completely. Correct?
Exactly. Market makers kept doing their job. Okay. Nobody refused to make a market. I mean, someone maybe did, but overall, we saw markets kept working.
Yes, absolutely. Okay, Simon, I'm going to put the same issue to you, and then to Abdellah. Do you want to talk very briefly, not for too long now because we're on almost 50 minutes, but talk a little bit about COVID-19. How did it affect State Street? And can you see us going back to? Is this just a kind of it's a very extreme blip, but it's a blip, and nothing's broken in the marketplace right now?
Yeah, I think Carlo covered it well in regards to the impact on sort of the illiquids. We haven't seen a huge amount of change there during this process. But what I would want to call out is the significant impact on valuations as a whole in regards to sort of exception levels. Globally, we've sort of seen 70,000 a day going up sort of 1.4 million. Huge volumes of exceptions because of the market volatility. And then as well as the fact that the valuation discussions, there was increased discussions around certain fixed income products, distressed debt, and ensuring a fair value could be gained when brokers or vendors were deemed out of the market, and to what one could actually trade at. And then working with clients in gaining more colour, that in turn can be used in those discussions with vendors to support challenges or amendment of price or source. Which obviously emphasises the need for strong practice, policies and government. Another thing I would say is because of the work from home, is the remote vendor usage being imperative, along with web-based solutions. It's something that probably, it's always had a degree of focus, but we've often heard teams globally and as well as traders say they can't value or trade from home because of terminals and because of regulation, and a lot of that has been mitigated now. So for me, things won't necessarily return to the status quo that was previously experienced. It definitely impacted everyone and will certainly leave a lasting legacy, but and there will no doubt be many negatives. But for me, to focus on the positives is something I like to do, and for me, it's moved us forward ahead of us where we would have been in regards to being more agile with work from home, office hours, vendor usage, and also how we service our clients globally.
Good. Okay. Let's leave that there. Abdellah, I'm going to ask you to kick off the final question. We haven't got enough time to go into COVID-19. You already mentioned the market volatility towards the end of March related to COVID-19, etc. So you've given a certain amount of color to that question already. We're going to be talking a little bit about what capital market firms should look for in a pricing valuations provider. Now, this I think is absolutely crucial to today's discussion. Abdullah, I'm going to ask you to kick off that call in a moment. Just once we've had a look at the results from the final poll question, you should be able to see the poll question in front of you now. I'm looking for it. Here it is. Okay. How many third-party evaluated pricing relationships does your firm currently have? 1 to 2. Over half of respondents said only 1 to 2. That is kind of understandable, given that there's a small but concentrated number of pricing providers that have fairly extensive reaches into all markets, asset classes, etc. So that's not much of a surprise. Although having said that, there were a quarter said 3 to 4, and another quarter said more than 4 as well. So I assume that would be, with those numbers, that would be for more of the specialist, more esoteric instruments, and also in emerging markets where you might be using a local provider specifically for those instruments. Okay, so onto today's onto the final discussion point. Abdellah, I'm going to put you on the spot a little bit and ask you what should capital markets firms look for from their pricing provider? What is the kind of the secret sauce that they should be looking for that kind of makes them choose one over any other? What would you say to that?
Sure. Thanks, Victor. I think the couple of things I want to highlight here. One is the methodology and the design of a particular methodology. It obviously depends on the client portfolio and the structure of the portfolio, what asset types we're looking at. But I think it would be good to really look into in more detail on how the methodology is being designed and whether that methodology is in line with market standards, with market practice, and it's also helping the client base to meet regulatory standards. I think that's important. The other part of it is the execution and performing the methodology, i.e. quality of prices. I think that's really critical, making sure these valuations are benchmarks on a regular basis. And then the other component is the coverage point of view, because you would want to have a let's say one vendor that would be able to help the client to cover all aspects of the fixed income and the credit market. So I think coverage is important. You can distinguish vendors between the mainstream ones which have access to a wider network, extended network of community, or the specialist ones that looks after specific niche markets. I think that's a decision to be made, whether you would want to go for a vendor that's able to cover the global area, or a vendor that's highly specialist in a particular sector or particular market. I think these are the kind of the key components as a first kind of assessment. And then the other part is really the transparency aspect, and making sure that you as a client are in a position to replicate the valuations and have the ability to have a debate and discussions with your vendor. I think that's critical. From a Refinitiv point of view, we highly value these conversations with our clients, because it does help raise the standards of prices, because it allows for additional angle of information flow when we have that conversation with our client base. Obviously, we have our own extensive network of working with the market making community or the broker community, etc., to be able to come up with a fair value pricing. But I think having that conversation with the client base also provides additional information that could justify and help justify fair value. I think that's important for a client when assessing a vendor, is to have that ability to challenge a particular price and to have a conversation and to assess the methodology and replicate the methodologies. And then the other also, which is becoming increasingly important, is the scalability, i.e. the technology aspect, applying advanced technologies. We back years, our clients tend to look into more of end-of-day pricing for their own reporting requirements for the NAV calculations, but we do see increased demand for intraday valuation. And the intraday valuations does require a highly sophisticated advanced technologies, because especially with the high volatile markets, you need to keep up with the amount of information, but also making sure that the QC, the quality control aspect, is applied correctly and appropriately. So I think technology is becoming increasingly important, and that's really also part of the conversation that our clients want to have when speaking to vendors on the type of the models, the technologies, and the infrastructure, and also the platforms of it. That's also important.
Yeah, actually, Simon, you brought the whole technology aspect and the formats in which data is delivered, etc., and how easily that data can be consumed and used within the organization as a key component of a pricing provider's service offering, right? Do you want to maybe just reiterate that and talk a little bit about anything else that comes to mind with respect to how you would separate out, one provider as opposed to any of the others?
Yeah, I think Abdul covered the majority of items really well. I think first and foremost, whenever you look at a new provider, coverage is the first thing you would check. Reasonable commercials, that's a given. Consistent, timely delivery, as you mentioned, using technology to promote automation, which is obviously going to reduce the risk. And then also gives us the ability to increase straight-through processing, which is obviously then contributes to the point we made earlier in regards to the timeliness aspect. So I think from the offset, you can see that flow and why you need it, right? Yep.
Absolutely. Okay. I'm going to put the final question to you, Carlo, and then we have just a couple of end-user questions, audience questions that have popped into the inbox that perhaps we can just touch on very briefly as we wrap up today's discussion. Carlo, how would you go about separating one provider from any of the others? What are the most important things from your perspective?
I risk to repeat myself here, but in a sense, I really believe that besides of course coverage and technical automation of all the processes, an area where I'm not particularly an expert myself. What I really want from a data provider is help me understand the data, understand deeply, so understand how. What is the best piece of information that I should use for my purpose, what is the meaning of that information, what is the best way to consume that data in models, and also market structure information regarding that piece of information. Where does this quote comes from? Does it come from a large market with a large representativity of this quote, because it's a large market share represented in that quote? Or I mean, there are a lot of aspects that are also regarding the market structure behind that piece of information. And also, again, I repeat myself, but I stress it, it's about benchmarking. So they have the possibility, and they typically do a good job in telling me what the others do in tackling any problem.
Good. Okay, gentlemen, let's leave that there. What I'd like to do very briefly, we've got two questions that I'd like to address. These can be fairly extensive discussions, or there can actually be no discussion at all, depending on the panelists' views on these questions. The first comes from somebody at Banco Santander, and what I'd like to do is just talk very briefly about. I'm sure you can read it in the inbox. To what extent have you had to adjust your internal models in the last few days to obtain better FVA? Does anyone?
Victor, I think we lost you there.
Okay, it's Simon here. I mean, in the essence of time and the fact that I think we've lost Victor, I think it's fair to say we can probably wrap up. So thank you all for dialing in, and you know, I personally want to thank my co-panels, Abdul and Carlo. You know, it's been a pleasure. Thank you.
Thank you, everybody.
Thank you.
Appreciate it. Have a great afternoon.